Investment banking, the holy grail of the finance world, the biggest wet dream of finance bros everywhere, and a career where six-figure salaries in excess of $170,000 are the norm, as an entry-level banker, with some experienced investment bankers earning as much as $500,000 to even $800,000. But what do these people actually do to earn so much money? And what the hell even is investment banking? On this episode of Business Capped, we're gonna find out. It goes without saying that the pay for these roles is insane, probably why every teen who's on the influencer side of Instagram is desperate to crack this industry. It's no wonder why, with the average Goldman Sachs investment banking analyst making an average base salary of $118,000 a year, with an average bonus of $51,000 a year. And these guys are at the bottom of the totem pole. If you work your ass off for multiple years and make it to managing director, with base plus bonus, you could easily be making $500,000 to $800,000 a year, with some making millions. Of course, that kind of money rarely comes with just sitting around doing jack shit. Well, unless you're a Twitch streamer. No, this comes with notoriously long, grueling hours, with the average being anywhere between 60 to 80 hours a week, with some bankers claiming they push 100 hours. This isn't even including the time spent bringing the work home. Some of these guys claim to never even shower, so safe to say there'll be many sleepless nights. An investment bank doesn't actually invest anything, nor does it even lend money to people. What an investment bank does is operate as a middleman between investors and investment opportunities. They're the realtors of companies looking to sell, a middleman, if you will. All banks are middlemen if you really think about it. In fact, the word bank derives from the word bench. A sperm bank takes semen from willing donors and gives the magic baby juice to women who want babies. A blood bank takes healthy blood from donors and gives it to those that need it. And a traditional bank takes money from depositors and gives it to people who need money. All an investment bank is a bank that takes investment opportunities from people who need investment and gives it to investors willing to invest. Simple, right? What ends up confusing people is that many of the big investment banks like Goldman Sachs and JP Morgan have diversified from just investment banking into other things like asset management and actual traditional investing and lending, like any other bank. All this only really adds to the confusion. The world of working at one of these firms is actually pretty boring, mainly spreadsheets and PowerPoints. All an investment banker really does is put deals together. First step of this is to find a client like a realtor would. Most clients would end up being business owners looking to sell their companies or some equity or go public. A sell-side engagement, as it's called. Then you build a list of potential buyers, of which there are two main types, a strategic buyer or a financial buyer. A strategic buyer is a buyer like another company that wants to buy their competitor or horizontally integrate to achieve supply chain dominance. A financial buyer is someone like a private equity firm which just wants to buy a company and grow it. Typically, as an analyst or an associate, being the bottom of the barrel means you don't really have anything to do with sourcing these deals in the first place. Maybe your vice president invites you to a networking dinner or two, but the bulk majority of your work is step 2, the pitch deck. The IB firm typically fields offers from numerous different investors to see who's going to give them the best possible deal for their clients. The big step once a client has been found is to convince the company that's selling to give you access to all their financial documents so the analysts and associates can begin their pitch deck. A big, fat, juicy 20 to 30 page long PowerPoint detailing what the investment bank knows about the company being sold and the industry it works in. It's also going to include fun little nooks and crannies like the team handling the transaction, who the potential buyers could be, and most importantly for the client, how much money they think they'll get from this, all things considered. Hours and hours of work making pitch decks, which oftentimes just gets thrown in the trash because the client decided they preferred the pretty font on another investment bank's PowerPoint, and they're going to go with them instead, or even that they can't be asked and would rather keep the company. Assuming your IB firm's PowerPoint was the one with the pretty font and you signed the client, now we're in luck and can move on to the next stage, the confidential information presentation. The SIP. At this point, the selling party opens all the documents up to the IB firm so they can make an even bigger, fatter, and juicier document that's 50 to 130 pages long, detailing things about the company being sold, its operations, financials, patents, and IP. Management team, why the company is selling or raising money in the first place, and other useful little details prospective buyers who are looking to drop tens, if not hundreds of millions of dollars might want to know. All of that information is continuously deposited into a pool of data, which back in the day was kept in a big fat room at the investment bank under lock and key, but now is all online on Intralinks or DataSite, which are basically a more expensive version of Microsoft SharePoint. All of this information is highly confidential, sensitive, and damaging if it were to leak. Part of the investment bank's job is to make sure this information is only shown to the people who are meant to see it. People who are actually likely to make a competitive offer, that is. Making these SIPs is a long, strenuous task which must be perfect. The details in these documents can be the make or break for deals worth billions of dollars, so if the investment banking team makes a little oopsie, they could be liable for the damages their fuck-up caused. An investment banking team is typically made of one managing director, the big daddy, a vice president, the little daddy, an associate, and an analyst. Some bigger deals and bigger firms can have more analysts and associates. However, having too many points of contact or people doing the same things can end up causing more harm than good, which is why these firms prefer to keep things nice and small. Once the SIP is complete and been triple checked for any incongruencies, it's time to show it to potential buyers and investors that the bankers and client have agreed on. Typically those lists have 80 buyers, and the next job for the IB team is fielding calls from all of these buyers and clearing up details of the deal. One of the best parts, because who doesn't love being asked difficult questions about 130-page documents and being expected to have perfect answers to it on the spot whilst your managing director, your boss, sits and listens in. Better not say anything slightly misleading that could be used to sue the firm later down the line. The first stage, marketing for the deal, can take a quarter of a year, in which time the team whittles down the list of potential buyers to 20 people or less. From those 20, having 5 of them stay interested would be a good result. For those that are interested, it's time to show them more confidential information, tour them around company facilities and have them meet the management they could soon be the bosses of. From those 5, a couple could send a letter of intent, or an LOI, with an offer outlining the terms of the deal and the amount they're willing to pay. If this offer is accepted, it's time for due diligence, unless it's not, in which case they negotiate or the deal just goes tits up. But assuming things are worked out, due diligence is where the IB team works closely with the lawyers of the buyers and the lawyers of the sellers and other third parties to iron out details. An accounting firm may look through the books to ensure everything is right with what's been said and what's true. Next up, they draft a purchase agreement document. This is a 60-page document outlining the terms and conditions of the deal. After a month of debating these details, once everybody is happy, the date for when the money will be wired is set and the deal is given the rubber stamp of approval. in which case the seller is now rich, the buyer has a new company, and the investment bank takes their fee. The investment banking team, after many sleepless nights, gear up to do it all over again, and they move on to the next. All in all, the job isn't the glitz and glamour that it looks like on TV. It's long hours of grueling work which takes a lot out of you mentally, and you spend most of that time behind your computer working on a bloody PowerPoint. If this sounded like a lot, most analysts will be working on 4 to 6 deals at the same time, so you can just quadruple everything I just said. If you're not working, you're sleeping, and if you're not sleeping, you're crying in your office, asking yourself what you're doing with your life. The worst part is, many firms have policies saying if you don't get promoted from analyst to associate within 2 years, you get sacked. Likewise for associate to VP. The job's much nicer for VPs and MDs, who spend most of their time networking at country clubs for clients and buyers and telling analysts what to do with much better hours and much better pay. The better pay is necessary for the country clubs, I guess. Most people don't actually stay in the industry for that long. They stick it out, get some years of experience under their belt, then they take their connections and experience to work at management elsewhere, or they transition to private equity, or they start their own business. The deals, experiences, connections that these people will make at investment banks are the real wealth of investment bankers and make them very good at whatever career path they choose to enter next, as they bring their infallible work ethic and willingness to work every hour of the day. If you're trying to learn more about finance, you have to watch my video on private equity, the grim reaper of business. It's the last video on private equity you'll ever need to watch, I promise. If you loved this episode of Business Capped, be sure to like the video so the YouTube algorithm can do its thing, and I can keep on making more informative videos like this one. Comment what you want to see a video on next time, and subscribe if you want to see more videos like this one. This was Business Capped. God bless you all. Goodbye.